right. So we were talking about this slide, then we had a break. So let's continue with the financing activities. I was talking about this. The slide before that was talking about cash in and cash out. That's simple, literal meaning of cash in and cash out. So cash flow for financing activities, as we talked a little earlier this morning, they are those activities that result in the change in the size and the composition of the share capital. All right, the size and the composition of the share capital, and also the borrowings. So there's only two things here, basically financing. You finance by borrowings or you finance by equity. Now, when we talk about borrowings, we have to take a wider approach in the borrowing. When we talk about, let's say, creditors, all right, it is also a form of borrowing when they give creditors, credit period, right? But then we don't actually put creditors in the financing side. Where we put them is the working capital portion. All right, now there's a working capital. So we lump all of these in the working capital portion and then adjust accordingly. I will come back to the example on the Pinewood shortly. All right. Okay, so the standard states that this information that we talk about on the share capital and the borrowings is useful to predict claims on future cash flow by providers of capital to the entity. Meaning, claims here means that what can they expect on the future cash flow? Can they expect a dividend? Let's say the company, the business is not so good and they want to actually do a voluntary winding up. What will be their returns from the company? And this will be the capital, and whatever retained earnings, they are called equity, right? That will be what will be returned to them. So information on financing cash flow actually indicates the extent to which a company has to borrow from the outside to meet the operating requirements of the company, or even to meet the investing needs. Like, for instance, if you want to set up a new factory, you may use part of your own equity, and there could be partly borrowings. So how much of it is borrowings, how much of it is equity? So it is easy to see from the cash flow. But if you look at the balance sheet, you can see it as well, but you can only see numbers at the end. Here you can see exactly this part is relating to investment. This part is financing. It is so much easier and more accurate to see it than on the balance sheet. Balance sheet gives you the liability at the year end, correct? All right, so this one does not tell you the whole year, but it tells you how much you have used, and that is what is exactly what is required. All right, so there is a difference here. And then moving on to the next slide, cash flow from financing activities include the following. So any shares that we issue to the shareholders, all right, proceeds from the issuing of shares, from the issuance of other equity instruments like preference shares, redeemable preference shares, RCPS, which is actually redeemable convertible preference shares. So all of these kind of things that we issue to the shareholders are actually part of financing the company. Although they are called equity, but technically the shareholders are financing the company. But because they are shareholders, they are not called financiers. They are called equity holders. All right. So payment to owners to acquire or redeem the entity shares. Now, this is share buyback. When you say payment to the owners of the share to redeem the entity share is a share buyback, or it could be a repayment of capital. All right, repay the capital to them and cancel the shares. So proceed from the issuing an outflow to repay debentures, loans, notes, bonds, mortgages, and other borrowings. In other words, when you repay any borrowings, any kind of loans, term loans, all right, bonds, notes are normally called what they call in real life practice, medium-term notes, MTN. It's just a word called medium-term note. It's a kind of a loan, all right, called by the name MTN, medium-term notes. So they are not something very special or whatever it is. It's just terminology given by bankers for certain types of products, and medium-term loans, they call them medium-term notes. So it's MTN, all right? And bonds, of course, mortgages are charges on the company's property for financing, okay? And payments by a lessee for the reduction of the outstanding liability, right? Now, relating to a lease. Now, this one is very simple. Now, when a lessor leases out something to a lessee and the lessee pays back the rental, that is called a payment of a liability, right? So you repay for the liability, and that is reduction of the outstanding liability relating to a lease. So here again, you look at it, whether it's a finance lease or whether it's an operating lease, and whether or not it falls under MFRS 16, which is talking about the lessor has got a right of use. All right, the lessor has got a right of use. The lessor has got an equivalent liability discounted at the bank rate of exchange to get the net present value of the total liability for the period for which the lease was shown. All right, so that will be a liability. So reduction of that liability will be, because you are the lessee for when you lease it from somebody else, when you lease the property from somebody else, you have a right of use, you have a corresponding liability. So when you pay back, that will be the payment of a lease that they are talking about here. All right. Next one is, of course, cash from financing activities. Cash. Now, financing means all forms of money that is coming in. Cash from the shareholders. If you're issuing a bond, private bond, public bond, whatever, the cash from the bondholders or bankers giving you term loans, as well as paying back all of them. All right, cash paid to shareholders. All right, so payment of cash to shareholders will be partly capital. It could be some of it capital, some of it could be dividends as well. So whenever you pay back to the shareholders, that repayment is actually payment of a dividend. All right, because dividend is, think of it this way. All right, in accounting terms, we look at it differently. But from a cash flow point of view, we treat that the shareholders have put in money. So if we pay them anything, it's a dividend. So when they put in money, it's a financing cash flow. So when you pay them the dividend, it's like a financing cash outflow. All right, the dividend is because they put shares, we are paying them. Although nothing in technical language can you call a dividend, all right, something called a finance expenses, except, of course, if it is a preference share which has been issued at the option of the holder. Now, all right, redeemable preference shares issued at the option of the holder. The holder can request any time after a prescribed period that he wants his money back. So it's equivalent to something that is payable on a term basis and repayable on demand anytime after that term. It's like a loan, so they treat it as a liability. So because that is treated as a liability, all dividends paid on such redeemable preference shares, redeemable at the option of the holder, that kind of interest is not treated as dividend. Rather, that dividend is not treated as dividend, but in the financial statement, they are treated as financial expenses, all right? They are treated as dividend, but like interest, because it is very similar to a loan. A loan given by the bank is for a period of time, and then on demand, they can call it back at the end of the period, unless you extend it. And then that any interest is on that loan. So same thing, redeemable preference shares are the option of holder. He can, after the end of the period, make a demand for it. So it's treated very similar. That's why a redeemable preference shares at the option of holder is actually shown in the financial statement as a liability, not equity. All right. But redeemable preference shares at the option of the company, that is treated as an equity, because the company can decide to redeem or not to redeem. If you redeem, then you got money, you can pay back. Just like share capital. All right. Share capital, if the company has too much money, it can also repay to the shareholders, called a refund of capital, and there'll be a capital reduction. Okay. Right. So here, Financing activities, all the cash paid to shareholders is also financing. Payment of dividends, okay, payment for share buyback, and the repayment of loan, the principal sum only. The interest is operating, remember just now, all right? Principal sum only on loans because the interest is considered operating activities and are shown in the OCF, all right? So, and I included in the category of payment of dividend under financing activity. All these are in the financing, right? So changes in cash from financing outside is a cash in when capital is raised, and when they are a cash out when dividends are paid. So it's whether cash in or cash out. If it's a liability, cash in is capital is raised. Liability, I mean cash out when dividends are paid. Okay, so you go by this thing. Asset is the other way around. All right. Now, so if a company decides to raise funds and they issue a bond to the public, the company receives the cash. All right. Because you're issued to the public gives you the money on the bond. They subscribe for it. You get the money. So, but when the interest is paid to the bondholders, it is actually reducing the cash. All right. Company issues to the bond to the public, receive cash. Pay interest, pay out cash. So you're reducing cash. Simple logic. It's not rocket science. So in consolidated financial statement, which we saw just now, financing cash flow will include those arising from if there is a change in the ownership interest, like shares. All right. If there are changes of ownership in the subsidiary that do not result in a loss of control. So that will be called financing. Example, all right? If you are actually investing, you already got 51% share. So it is a subsidiary, right? Now you increase your shareholding to 80%. That is an investment in the subsidiary. So it is a cash flow that is going out into the subsidiary, right? Now, what happens if you sell that subsidiary? Okay, no, you don't sell the subsidiary. You sell 80%, 10% of the shares you sell. So from 80, you come to 70. What will that be? So what it says here is in the consolidated financial statement, financing cash flow will include those arising from changes in the ownership of interest in the subsidiary. In our example, from 80% to 70%, that do not result in the loss of control. You still control the subsidiary at 70%. All right. So when you're paying back from 70 to 80 to 70, and you pay back, this is called financing cash flow. All right. Okay. Now, not all cash flow statements are healthy. Now, you look at this. This is called a negative cash flow. Negative cash flow, right? So what do you expect negative cash flow? All bracket, 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 bracket. Can this company last? Is this company viable? Sure, close down one, right? Or some people say, sure, chop up one day. Okay, probably so. So, no. And now, that's what we say. But remember, not always true. Not always true. So we cannot generalize. That's why this is a very fine piece of a document, the cash flow statement. It requires a bit of skill to analyze. So let's go through it. So negative cash, so not all cash flow statements look healthy or exhibit a positive cash flow. Negative cash flow also should not automatically raise a red flag. You should not say, oh, negative, a red flag. This company sure not got a problem. No, you don't. Sometimes, as what I said earlier, and we will now look at that area, negative cash flow is the result of the company's decision to actually expand its operations at a certain point by investing in new assets. Now, is that good or bad? If the company is all the while profitable, it's okay, it's good to expand. But if the company is all making losses, is it good to expand? Then again, the answer is not a direct yes or no. If the company is making losses, probably the industry or the product you're manufacturing is already a waning product going down. So now you want to include a new product line, which could be a game changer for the company, right? They could suddenly say, oh, when they sell this new product, the demand is there and it picks up. So again, that's why it cannot generalize. But having said that, we normally look at a negative cash flow as not so good. But only when you take that extra step further to find out what are the reason, are they spending on investment, that means purchase of assets, etc. Then we have to ask next questions. What are they spending on the new assets for? And then you probably will get an answer, because the line that we are in is a dying line. We want to move into a new area. All right. So this is something that it will be looking like when you ask questions. Let's say the company once upon a time was doing cameras and rolls of film, Kodak cameras, Fuji cameras, rolls and rolls. Remember the time when you wanted to go anywhere, you had to first run off to some shop and get some rolls of film before you want to go overseas or this thing for your cameras. Now, today, where are those camera shops? Obviously, some of them are still surviving, but they are not selling cameras. They are selling other things, probably move into handphones. All right. So that's why if they change like that, they would have survived, and they are surviving. But if they didn't change, those shops that only want to stick to camera would have died. So their cash flow at that time would have been negative. So if they change the business, they could have turned into a different thing, because the demand for handphone is always there. And look at the proliferation of handphone shop as an example. All right, it's an example. Does not always mean negative cash flow is bad. We have to examine in depth. Then only it's all right. Okay. So negative could be the result of the decision to expand business at a certain point by investing in new assets, which actually is a good thing for the future. So what we need to do is analyze the cash flow from one period to another, and to gives the management a better idea of how the company is performing. It also gives a good idea to an investor and the reader of a financial statement how it is carrying on, and whether or not a company is on the brink of a cash flow deficiency, or on the brink of a bankruptcy or success. Sometimes we may look at it this way. A company that is going down, we will look at it and say, look at the asset, look at the liability. This company here, sure, going to close down one. All right. But then remember, the directors may have a different direction. Right now, we are going to borrow from the bank. We have security. All right. We will borrow from the bank because we are working on a new project, and we are going to get a new contract for the project. You see, the focus is on something new, but the reader is the historical view. This company cannot. But the other party is looking at, let's call the past the past. It's done. Let's move forward. So they move and get new capital, and then so they get the new loans from the bank, and the bank looks at the project that they are going to get viable. They got security, so they give a loan, and then the company picks up. So you see, that may not be evident immediately on the cash flow statement until the loans are all released and the project is going. So that's why we have to actually understand better by asking ourselves question, is this company going to fall? Is it going to go to bankruptcy, or will it turn around? Okay, now that is the analytical mind that you need to have, or rather the students need to have when they learn something about a cash flow statement. If they just learn something about a cash flow statement just to regurgitate out for the examination, then they come out as blur as they went in, right? Okay, now the final analysis of the cash flow statement, the bottom line. So a cash flow statement is basically a very good measure of the strength of the company, the profitability of the company, and the long-term future outlook of the company. Now let's take them one by one. Strength. If you have the cash resources, you have the reserves, you can grow on the company much better. You need to invest in new machinery, you can do that. Profitability. Now, Why is the cash flow statement a valuable measure of profitability? If you have cash, you can negotiate. You can negotiate with suppliers. You can bring the price down on the supply of goods that you purchase, which means that you can have a better profit margin and your profitability per se is going to go up. All right. Now, this is one of the things you can do. Or you can buy in volume and bring the price down. Okay. So many things can be looked at in the long-term future outlook. So the cash flow statement can help determine whether a company has got enough cash, liquid, to pay its expenses. So we always remember one thing. You must pay your expenses in good time. Once you delay payment, the compounding effect of delaying not enough money to pay, then try to work from what you sell, you try to pay, sell, pay. That is going to be a very critical situation in the company. So they must always be paying on time. All right. So a company can use a cash flow statement to predict the future cash flow, which will help on the matter of budgeting, how to do that. So you know how much cash you are getting. You know how much is your incremental cash every year on the cash flow. So you know that we are actually slowly increasing our cash. So because we got cash there, rather than investing in a fixed deposit, why don't we invest in our own business? In other words, increase our purchases so that we can increase our sales and bigger profit for us, rather than putting in the bank and getting the 3% or whatever it is. All right. Why don't we invest? We will be getting much more money. So we can now project from the cash flow statement what is our progress and how much we can increase our purchases to generate better sale. And when we increase our purchases, all right, we may have to increase our sales team or whatever, and we may need to have employ more staff. How will that affect as well? You see, one will lead to another. Now, on that is all on budgeting and cash flow forecast. So that is where you will transfer the cash flow statement assessment into a budget and a cash flow forecast based on your 3 or 4 years cash flow statement, right? So moving on, this is not a hard and fast rule. Sometimes negative cash flow is because from a company's growth strategy by expanding the operations, as we saw earlier. By studying the cash flow statement, we get a very clear picture of how much cash the company generates and a solid understanding of the well-being of the company. This is like putting all the things on the human body by a doctor. He's monitoring your heartbeat, he's monitoring your blood pressure, he's monitoring your whatnots and whatnots and whatnot, which only a doctor know. We are all accountants. We don't quite know all of them. All I know is that every 2 years I go for a stress test. I'm being pinned up with all these little things there, and I got to run on that wonderful treadmill that they have. All right. And the treadmill is not a problem because I also have a treadmill. But the problem is the doctor who's standing beside you, monitoring all your whatever it is on the machine, is slowly raising up that thing higher and higher and increasing the speed of running. You got to hold on to that thing, and you have to run fast and up a hill. My God, the most I can do is 11 minutes. I can't even hit that 12 minutes sometimes because you run out, not because I run out of breath is yes, but I tend to fall down. So the nurse behind is pushing me up. So I say, anyway, that's something else, all right? So anyway, this is not a hard and fast rule. Sometimes negative cash flow results from a company's growth strategy by expanding operations, as we saw earlier. So by studying the cash flow statement, we get a clear picture of how much cash the company generates, solid understanding of the financial well-being. So this is assessing the company. So we come back to the more important point just now, which we touched on very briefly. What exactly are cash and cash equivalents? And I showed you on that Pinewood accounts, all right, where you have the balance sheet cash different from the cash flow statement cash. And to reconcile that difference, what we had was a note on the accounts telling you this is what the actual amount is, but this is what the cash flow statement is showing what is the difference. These are all fixed assets, fixed deposits that have been pledged for some kind of security given by the bank. So you cannot touch it. Even you want it urgent, whatever, you cannot touch it. All right. So that is the cash items that you cannot touch. So they will never be cash and cash equivalent. Basically, only assets that can be, fixed deposit that can be uplifted without any problem. You will not lose your capital. Those will be considered as cash and cash equivalent. And in the practice is that anything more than 3 months, generally, but not specifically, is not considered cash and cash equivalent. If you want to consider it, that means to say you should be able to get the money straight away. Straight away means, of course, maybe 1 or 2 hours later. It's not about wait for 3 weeks before you get the money. No. All right. And you must not lose the capital that you have. That is the most important. There is also some kind of investment, some marketable securities where it never loses the value, and probably things like maybe government securities and stuff like that. Those can also be cash and cash equivalent. Now, those also can be. Let's have a look at it first. So cash equivalents are short-term, highly liquid investment, readily convertible to a known amount of cash. All right, so known amount of cash, but this is the catch here, which are subject to a very insignificant risk of changes in value. So the change in value must be practically nil, insignificant risk. All right, maybe you pay some bank charges. Otherwise, you'll get in full. But you don't go and you say for 100,000, you get back 95,000. 100,000, you get 100,000, you get 99,500. That is a loss in value. That is not an insignificant risk of change. Right? So the objective of the statement of cash flow is to provide the analysis of changes in the cash and cash equivalent. So let's look at what are cash and cash equivalents. We'll dig deeper into this. Now, an investment qualifies as a cash equivalent only if it is held to meet short-term cash commitment and satisfies the defining criteria in the previous slide. Once again, only if it is held to meet short-term cash commitment. We have too much cash, but we don't want to keep it here. We want to put it even for 2 months in something. Short-term cash commitment. So what is short-term? That's the question, right? So entities are required to disclose the composition of their cash and cash equivalents. That's why the notes on the account explains it. All right? As well as their cash management policy under paragraph 45 of MFRS 107 and also paragraph 46. Now, if an entity changes the purpose of holding a certain investment, right? You want changing from short-term cash management to generating investment return. What is short-term cash management? We have cash. Normally, businessmen don't like to keep cash idle. This is like they will get a heart attack. I mean, not literally, but in a manner of speaking. There's a cash. This cash money. Put somewhere. Even I get $10, it's 10 ringgit. If I get 20 ringgit, it's 20 ringgit. If I get 300, it's 300. It's money. Well, that is true. So if you are using this kind of thing to cash manage it, all right, you don't need the money for the next 3 or 4 months. You want to manage it, putting in cash. It's different from investment return. You are not putting the money. Let's see how much we can get. No, is that whatever is given, I want to take. Because I cannot keep it idle. Idle is 0, 0, 0. Right? I got money. I can't keep it like that. Now, this is important to them. So therefore, terms cash management to generating investment return is longer term. This is seen as a change in the facts and the circumstances. If you change the holding from a cash management to a cash generating is different. All right. So such a change is accounted for prospectively. It will appear as a reconciling item in the cash flow statement. Let's say last year, I put 400,000 ringgit into cash management because I expected to use the cash within the next 1 year. So I put cash management anytime I can draw it out. Okay. Then I realized, I mean, as we go along the day, the company says that, no, I don't think we will invest in whatever we wanted to. We will just leave the cash there. Let's keep it for a longer term to earn the interest. So what have we done? We have changed our intention, all right? The purpose of holding from a cash management to a cash investment return. So in the statement of changes in the cash flow, in the cash and cash equivalent, we will now no longer put it under cash equivalent. I mean, we will not put it under cash and cash equivalent, yes, but rather change it to an investment. And that is called accounting it prospectively, because we just made the difference, the change. So we have to change it moving forward, not retrospectively, because at the material time, retrospectively, at that time, the decision was cash management. But now the decision changed. So we cannot go back and change the comparative. It'll be now. All right. So it's a reconciliation item in the cash flow statement. Then you have this thing called a demand deposit. Now, demand deposit is a deposit that is repayable on demand. All right. So a demand deposit is whatever money you put in the bank is a demand deposit. I put money in the bank. Can the bank say, no, 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 you cannot take out the money first. Next week you come and take it out because this week you can't withdraw. Now that is not demand. That all money you put in current account is on demand. You are not going to pay, they are not going to pay you in any interest. Rather, if you don't demand that money out, they will use it to invest and earn interest. Right? They loan it out to other people. Of course, this is called the loanable funds theory. And there is a certain amount that a person will use. A certain amount only he will withdraw. So therefore, the rest of the money will be loaned out. But if you need it, you will get all the full amount anyway. Right? Anyway, that's his banking issue. We will leave that out for the moment. So a demand deposit is not explicitly defined in MFRS 107, but understood as amounts that can be withdrawn on demand without prior notice and without penalty. Okay? If I make a payment out of my bank account today, I don't need to tell the bank, hey, hello, I'm paying 1,000 ringgit. Please note, in case you didn't have cash in my account, I'm going to pay. No, I can just use it anytime I like. All right? So what qualifies as, now remember, without demand and without penalty. Keyword, no penalty must be charged. So whether an amount qualifies as cash equivalent may be more significant than its classification as a demand deposit. It's classified as a demand deposit, but is it a cash equivalent or not a cash equivalent? Right? So to qualify as a cash equivalent, the instrument must meet 4 conditions. So let's understand the 4 conditions. First, it must be short term, 3 months or less. All right? That's the condition. If it's 4 months, it's no longer short term. It must be highly liquid, all cash. Or if it is not in cash, is readily known, convertible to a known amount of cash, known amount, subject to insignificant risk of changes in value. So there will not be subject to it is subject to a change in value, but it is an insignificant risk. All right. The word insignificant risk is a judgment item. You need to use professional judgment to identify what is a change in insignificant risk. Now, cash held in a foreign currency is still considered cash and cash equivalent as long as you can go to a money changer and change it, or the bank will change it for you. Now, what happens if you have foreign currency, all right, in cash, and the bank say, oh, this one we can't change, this one we can't change, that one you can't. That is not a cash equivalent. As a matter of making sure we are clear on this. Money market funds. Now, big companies always put money in the money market fund managed by the bank. All right. I know a client who has got enormous amount of money. Let's leave it as enormous. Okay. And the banks are always eager to make sure that the monies in his account are not sitting idle. All right. They will always be telling him, pestering him. Well, put here, put there, put here, put there. Why are you wasting your money? This is a huge amount of money. We can make huge amount of money, blah, 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 which is true. Actually, he does from the money. He doesn't have to do anything. All right, the huge amount of money makes huge amount of money. And the bankers are managing. But the bankers also are smart because when they put, they get their management fees. They get their whatever fees, right? So it's a win-win lah. At the end of the day, is the client's cash that is going up. The others are earning. The bank is also earning. But if you don't have two people doing this, you cannot make that kind of money. All right. So, and of course, the bank charges are there, which is not small. You don't look at the bank charges in your bank statement and compare with the bank charges they charge there. All right. You can be looking at a month's bank charges of a few 100,000 bank charges, few 100,000 for one particular account. We are looking at what $10 the bank charged me, a damn expensive one. $5, no, what this one. You see, this is the relative mind. All right. In relation to what we have, these are expensive. But these businessmen have broken that barrier. They have gone beyond it. So they are not interested in what are you charging? I mean, they are interested. But they are interested in what can I get out of it? How much is my earnings? Because whatever I earn out of it, you only take a minuscule amount as a bank. All right. Relative to it is a minuscule amount. But if I don't agree to that, I'm not going to earn. So you see, this is what we call the money market funds. Okay. So money market funds can be considered cash equivalent if they satisfy the four conditions that we talked about just now. So the focus is on the liquidity of the money market fund itself. Especially the investment can be sold back to the fund at any time. So money market, they may invest in a fund, that fund can be sold back and get back the money. Now, these money market funds are working this way, all right, to serve a purpose, to serve many purposes, not a purpose. Huh? So because you got so much money, you leave idle in the bank, it's difficult for anybody else to actually make money. Suppose I want to go to the bank and borrow, all right, to do a project. And the bank says, oh, I can't give you because I don't have enough funds. But this fellow has an enormous amount of funds. He's not going to use the money at all. So if you put it in a fund, that money is released and it comes to me. I can make money. I have to pay interest to the bank. So the interest bank is collecting interest from me, paying some interest to him. All right. And some charges to manage it. So they collect from both sides. And I'm making money on the project. And I pay back the loan. So this is the multiplier effect. I think everyone knows all of this. I just want to highlight this as what cash and cash equivalent means. All right. So the factors to consider for the word that we use, insignificant risk of changes in value, include how is the maturity of the underlying investment? What is the credit ratings? What is the nature of the investment in which it is held? What is the level of diversification so that the investment is not at high risk in any way? All right. And what is the guaranteed returns? So you have to look at all this to consider whether an investment has an insignificant risk of changes in value. So this all is a decision. All right, it's a judgment called a professional judgment. Right. Next one, investment with maturities greater than 3 months. So just now we said 3 months is it. So MFRS 107 restricts the inclusion of investment in cash equivalent to those with maturities of less than 3 months to minimize exposure to market risk. So it's 3 months. Now, investment with original terms longer than 3 months are not reclassified as cash equivalent, even if their remaining maturity become less than 3 months. So if you have investment for 2 years, fixed deposit 2 years, so definitely not a cash and cash equivalent. Now, what happens if you come to towards the end and you put this investment sometime in, say, November? So next year, 2 years on, 31st December, you are closing your accounts. Can you do a cash flow statement? Oh, this is going to mature in about 2 months' time. Is cash and cash equivalent? The standards say no, because you can see this. Investment with original term longer than 3 months. our example is 2 years, are not reclassified as cash equivalent, even if their remaining maturity only 3 months left. No, right? So investment should only be considered as cash equivalent if they are nearly as liquid as cash, not as liquid as cash. Note the word nearly as liquid as cash, and exposed to the market risk is very, very minimal. Okay. So fixed deposit with original term longer than 3 months might still be considered as cash equivalent. Now, you see this? There are always some riders or some kind of escape clauses. Original term longer than 3 months, you should not. But you can still consider as cash equivalent under certain conditions. Low penalty for early withdrawal. That should be very low. It must not touch your capital. All right? You are earning interest, but they give you slightly less than the normal interest that they will give you. Some banks do this to encourage more money to flow into their fixed deposit. Otherwise, they become too restrictive, right? Bank overdrafts, what are they? Cash and cash equivalents or not? You would think, well, very simple. It's repayable on demand, isn't it? All right, so bank overdrafts are considered cash and cash equivalents if they are part of the entity's cash management strategy, demonstrated by frequent fluctuations from positive to overdrawn. That means to say I'm using my overdraft. I use it to buy certain things. Then when I sell them, the money comes in, the overdraft becomes covered back. And then I buy some more, it goes on again, overdraft, and it comes back. Now, this is a very active thing. Now, if this is the case, they are actually part of the cash management strategy, and they are considered cash equivalent. Overdraft is cash equivalent. But let's say the overdraft is left there. All right, it's all the while overdraft, overdraft, overdraft. Okay, there's no money to pay back. So the bank giving you the facility, all right, and you pay whatever you sell, you pay back, still not enough to cover the overdraft. So maybe you got 300,000, the most it come back 150, then it goes back up again. 150, 120 goes back up again. Never clears the overdraft. So what does that happen then? So if they do not fluctuate from negative to positive, often they are considered actually financing and not a cash equivalent. So we must understand the characteristic of a bank overdraft. So we cannot say blanket, oh, bank overdraft, that one is cash and cash equivalent. You can't say that. You must look at the characteristics of the overdraft in the particular company. Okay. Because don't use the term it's payable on demand. Yes, the bank can payable on demand, but you don't have the money to pay. So how? Okay. So now we come to another strange one. Cryptocurrencies. They are not yet legal tender. All right, in Malaysia, definitely not. And they are not accepted in great quantities around the world. All right, but they have a presence in the world. They have a presence in many investors' portfolios and stuff like that. Okay, now whatever it is there. We must understand a little bit, right? So what are cryptocurrencies? Firstly, cryptocurrencies are not considered cash equivalent. Reason, they don't have any cash. They lack the key characteristic of cash. Can I take a crypto and change immediately into cash? No way. No way. All right, they got one sum of procedure, don't know what it works. I'm not a crypto fan. I don't invest in crypto. I don't believe in it until it becomes legalized by the Bank Negara. Right? Because I don't think so that we want to be a speculative. Yeah, some people say, hey, my crypto making plenty of money. Go ahead, enjoy yourself. I don't need that kind of thing because I like to sleep well at night. I don't want to be wondering, what if my crypto suddenly fall up, suddenly go up? No. All right. So the interpretations committee of the standard setter, the International Accounting Standards Board, has an interpretation committee called the IFRIC. All right. Noted that cryptocurrencies are not widely used as a medium of exchange to the extent that there would be basis for measuring and recognizing transactions in the financial statements. So as of now, all these are not taken up. They are more on a speculative nature. They are always used by people who are either for some reason drawn into it, and then they use that crypto for whatever it is because they are forced to use it, or for those people who want to do some kind of, speculative to make money, or they make crypto because their friend is doing it. Well, I don't say crypto is not making money. I'm just saying that it's not regulated in the way money is regulated. Okay. Right. Now, yeah, some people say crypto cannot fall. You got it's impervious to inflation and all that stuff. Now, restrictions on the use of the term crypto, use of the term cash and cash equivalent. Restrictions are disclosure. All right. Entities must disclose significant cash and cash equivalent balances that are not freely accessible, along with management commentary explaining the reason for the restriction. All right. So you must always say why. Now, did you see just now in the notes? All right. We did say there is a restriction on the fixed deposit because there is a charge on it. Okay. So you have to state that. Explain. Now, type of restriction. Restriction can come from legal requirements like exchange control, internal arrangements within a corporate group. So if there is, you may have to do that. Also, eligibility for cash and cash equivalent. The nature of any restriction impacts whether the asset can still be considered a cash equivalent. If the restriction causes the asset to be no longer highly liquid or readily convertible cash, he will not qualify to be a cash and cash equivalent. Let's have a look at some little things on the next slide. Restrictions. Balances can be considered cash equivalent if they are restricted due to covenants for short-term obligations but are not formally set aside. Short-term obligation, they can still be considered cash equivalents, all right, if they are restricted due to covenants for short-term obligation, but that is only an obligation. The fixed deposit is not formally set aside for the purpose of the obligation, because you may be changing your fixed assets. So they allow you to do it. Only when something goes wrong, they will clamp on a certain amount of fixed deposits, all right? So, but you still can use it. So if cash is formally set aside, like in an escrow account for a specific project or regulated minimum cash balance, then that escrow account which contains your cash is not even a cash and cash equivalent. Why? Because it's now restricted, okay? Because for a specific project, you need this money on standby. The escrow account cannot touch. So even though it's cash, you look at it, it's cash, but it's not cash and cash equivalent, okay? Now, the assessment criteria. So the terms and conditions referred to in the restricted accounts and both parties' access to these funds must then be evaluated to determine whether it is classified as a cash equivalent. So that's why when you have some money put in a restricted account, okay, sometimes in real life practice, some companies are running business, non-stop, blah, blah, blah. And, the directors are very active. They go to the bankers, they speak, they want more facility, and the bankers speak to them, and the bankers are willing to help them. And they say, okay, good. So this part of your fixed deposit, we will, just have a fixed deposit, right? So let's use it as a kind of this thing. So to them, yes, I got my facility. Whatever you thought fixed deposit, you cannot touch anything of my money. Is my money, right? Okay, whatever it is, give us the facility. We want this 300 million facility for a project. So they are very happy. And then the banks do all the necessary paperwork, blah, 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 blah. And then there's something that puts it into a restricted amount. All right. Now, sometimes directors don't know about it. Really, in real life, they don't know. They know something, but they don't know what's the nature. They never know about cash and cash equivalent. So when we look at let's say I'm putting my hat on as the auditor now. When I'm doing the audit or my staff are doing the audit, we circulate to the bankers for confirmation. Then they will tell us this is a restricted amount for this. Then we know, oh, this amount is restricted, but it's no documents nowhere to be seen. But the bank has confirmed. So straight away, we will lock that amount up and it cannot be a cash and cash equivalent. All right, so that's the way it is. Even that one that you saw in the accounts that day, I mean, just now, this morning, not that day. Yeah? All right. Many years ago, when this was locked up like this, we discovered it through a bank statement. All right. The client was not aware of the whole details of this. They are aware, but they are business people and they are very astute and very astute business people. But they are not on the account side. So the accounts people had changed at that point in time. So they were not very clear. So they put it as cash and cash equivalent. So when we took it, we put all that thing to restrict that, all right, with all the documentation. So this is where you need to understand that not easy sometimes to know. Whoever comes out and works as an accountant, all right, he must be very focused on all of these standards things. So when there is a fixed deposit, when he's doing the financial statement, he's doing the cash flow, he has to understand what would I put under cash and cash equivalent. That will be the student that you are training. He will be one day out there, maybe in some finance, some finance area, financial controller, whatever it is. He should know that he learned that this kind of restrictions do exist, and that sometimes you must go beyond it because directors negotiate and then they sign all the documents without knowing. All right, without them knowing the details of it. The only thing is detail. Are you releasing to us? What's the rate of interest? Can you reduce the rate of interest? Okay, this one. Okay, fine. I want the project. I want that money. We are having the project. We'll go ahead. That's what they want to do because they look at the big picture. They want the big money. They are not interested in what is your account show? What is my account show? Cash equivalent. What's all that rubbish? If I didn't have this big project, all that rubbish will not come in account. Now that is their mentality and their thinking, and they are quite rightly doing what they are doing, and we are doing rightly what we are doing. We are on the finance part. That's why it takes a few people to run something. So finance will advise. Now, if the financier doesn't advise, he will probably do it in the accounts, and then he can do. But these are the people, as I say, who are going to be trained through the university, are coming out to work, and will pick up, right? All right. Now, so the terms and conditions must be looked at. Next one, contentious issues, all right, on how to allocate the item to operating or investing and financing activities. Now, before that, there are some questions. I will address them. All right, so then the first one was preferred shares. Are they liability or equity? They are either. How does it work? All right. Preference shares, there are two types. All right. Preference shares that are not redeemable at all. So they are actually equity. Okay. They are preference shares, they are equity. And they live there for a lifetime until the company winds up. The other one is called a redeemable preference share. It will be redeemed when the company has the money. Okay, so normal preference shares, redeemable preference shares. One is equity, the other one also equity. All right, redeemable preference share, also equity. Now, that redeemable preference share, we split into two. Redeemable at the option of the company and redeemable at the option of the holder of the share. Now, what does the two difference mean? Redeemable at the option of the company means the company has taken in this money from the redeemable preference shareholders, and they tell you, when we have the money, we will redeem the shares. That means pay you back. All right. In the meanwhile, maybe if there's interest, we will pay. So whether it's cumulative or non-cumulative on the dividend. All right, that's the normal kind of terms. So in the meanwhile, it becomes part of your equity. Okay, so if the company has money, they do a capital reduction and they pay off the redeemable preference share. Now, the other one is redeemable preference share at the option of the holder. Holder means the person who's holding the preference share, he would have been given the conditions of that redemption. You can redeem the shares anytime after 5 years, 6 years, 7 years, whatever it is. All right. That means to say, let's say it's 5 years. At the end of 5 years, before 5 years, you cannot redeem. So you're holding on to your rights and the preference share. Your letter says you are the preference shareholder. And then when the 5th year comes, the last day, the next morning, you go to the company and say, Mr. Company Secretary, I need money very badly. I want to redeem my shares. Can you pay me back? So you have to pay him because option is on the holder of the share. So it's like a demand that you have to pay. So redeemable preference shares, redeemable at the option of the holder, is called a liability. So that's your answer. All right. It is a liability. So all normal redeemable preference shares are equity. Redeemable preference shares at the redeemable at the option of the company is equity. Redeemable preference shares at the option of the holder of the shares is a financial liability. So all redeemable shares that are equity, all money paid to them in the form of dividends are called dividends. So they are not shown in the profit and loss account because they are not a charge to the company. All right, they are in fact a distribution of the surplus funds by way of dividend. So they go into the statement of changes in equity. But the redeemable preference shares, redeemable at the option of the holder, because it is an on-demand thing after the period, it becomes a financial liability on the balance sheet. So under financial liability, you will show there redeemable preference shares. How many percent redeemable preference shares? All right. Now you pay them dividend. That dividend is not a distribution of dividend. Rather, it is a charge to the profit and loss account. So under finance cost in the P&L account, all right, indirectly in the P&L under finance cost, you got this dividend. So you might look at it, hey, how can you put dividend in the P&L account? The dividend is for the preference share. The preference share is redeemable on demand. That means redeemable at the option of the holder. So there you are. That is the way it works. All right. So I hope I've answered that question to you. Once again, if you are not sure, you can continue to ask. Next one, how about overnight loan to the bank for 3 days? Overnight loans generally, as long as they are not continuing, they are cash and cash equivalent. So this one is a cash and cash equivalent, all right? Because they are overnight loan. Now, if the bank restricts a certain part of your money for a period of time to put it in overnight loan, then that becomes restriction. But if it's just putting in overnight loan, you can take it out anytime. All right. That's why you earn that small amount of money. Over time, you earn a lot. So it is cash and cash equivalent. All right. Next one. Cash received from an investor while pending the share allotment to be done should be treated and parked as liability or equity as at 31st and given that the year end is 31st December. Now, these are called share application monies. All right, share application monies will have to be first approved by the board to be allotted as shares. So once it's approved and allotted as shares, then only it becomes equity. Before being approved by the board, it is not equity at all. All right, so it is definitely a financial liability. Now, once approved by the board as a shareholder, you automatically become on the register of members, and therefore you become equity. All right, remember that only that. And don't forget, in today's Companies Act, there is no requirement for share certificates. All right, there is no requirement for share certificates, unlike the olden days under the old 1965 Companies Act. The minute you give shares to a person, eventually you must give him a nice, beautiful certificate. All right, but now no need already. You can, if the shareholder wants it, then the company will give it to him. So that means to say, on the point of approval by the board of directors, they have accepted your subscription for shares, and therefore now you become a shareholder. Only on that date onwards do you put it under equity. Before that, share application money under financial liability, all right, or other creditors. Right, so this is answered. Next one, restricted bank account will be disclosed in the notes or only in reconciling item whenever you have a restriction on any bank account, it's just like any asset. A bank account is an asset. If you have property, plant, equipment charged to the bank, there's a restriction, right? You have to state that restriction in the notes on the account. Secondary one is you only talk about the cash and cash equivalent. So similarly with anything else, even you have a floating charge on your inventory. You know, sometimes bank says fixed charge on the assets, floating charge on the inventory of the company. Now, that means to say, by right, if you have a fixed charge on the inventory, the stocks of the company technically cannot sell the stock, cannot sell the inventory. If they cannot sell, how to pay the bank, right? So therefore, the way around it is the bank puts a floating charge. So you can sell, right? You can sell, buy new stock, sell, buy new stock. But basically, at the background, if anything goes wrong, the banker will take over your inventory and your whole company as well. You cannot say, hey, only take the asset, don't touch my stock. You can't, right? So therefore, in this case, all assets, including a bank account that's restricted, if there are restrictions, you are required to disclose it. Now, that is in the standards, all right? So any restriction on any assets of the company must be disclosed, okay? So reconciling the cash flow is secondary. The first one is you must disclose. So I've got that right. I've got that answered. So keep the questions coming. Okay, don't be shy. I'm happy to answer questions. All right. Contentious issues. Sometimes it is not clear how cash flow will be classified between operating, investing, and financing. All right. So MFRS 7 provides additional guidance because of this on the classification of certain transactions, which include like interest, include dividend, income tax, while other questions that we may have on where to put it, they are not addressed specifically. Those are required for us to use our knowledge, practical knowledge, applied in the situation, determine whether there is any significant risk of the value changing. Then we make that decision. All right. So, and these and some common areas where judgment may be required. Let's look at the following slide to get a good idea of it. Now, interest and dividends. Now, what's interest and dividends got to do with this? Now, we must disclose separately cash flow from the interest income or interest out paid out and dividends received and paid out as well. And their classification of interest and dividend is either operating, investing, or financing. All right. So we have to make a decision on this. And once we make a decision, it will be applied in a consistent manner. So let's look at this now. Just now, we asked the question on interest and dividends. All right. Now, we are talking about the redeemable preference shares that was asked earlier. So this is a very good question also, because that will be one of that items that will determine here. So a redeemable preference share at the option of the holder. All right. The dividends go to P&L account. All right. As an interest expense or interest charge or finance charges. Okay. What do you think will appear in the statement of cash flow? Do you think that's investment? No, it's financing, because the redeemable preference share is repayable at the option of the holder. Is a financial liability. So in itself, it becomes a financing thing. So any monies paid to the preference shareholder comes under financing. All right. Now, the other fellow who also subscribed for the redeemable preference share, which is at the option of the company and not the holder. So the company can anytime want to pay back, they can pay. If they don't want to pay, they won't pay. Okay, simple. So what are they? They are dividends. Where does the dividend go? Into the statement of changes in equity. It does not go to P&L because it's not a distribution of income. I mean, it is a distribution of income, but it doesn't go to P&L. P&L is a charge. So it's not a charge to the profit and loss account. So it goes under statement of changes in equity on distribution of income. And so when we look at the cash flow, what would it be? Certainly it's a share. A share is an investment. So as you pay dividend, it will go into the investing operations, not the financing. So redeemable preference share at the option of the holder, financing is the dividend. Preference share at the option of the company is investing activities, is the interest. So you see, you need to understand this. Otherwise, hey, they want dividend, or this one dividend, why like that? That's because we didn't go deeper. So an entity is required to disclose separately cash flow from interest and dividend received and paid, and their classification either as an operating, investing, or financing, and should be applied consistently. So don't change, right? So consistency is one of the elements of financial reporting, is even reflected in paragraph 31. Now, for a financial institution, if you're talking about a bank, finance company, itu lain cerita. Interest paid and interest and dividends received are actually all part of their operation. They live, they breathe, and exist on interest and dividends. That's what they do. They don't have trading profits. Okay, they don't have contract profits. They cannot. Their duty is to make money from money. All right, money is their stock in trade. So if I keep the stock in trade, plenty, I'm not making money. If I release the stock in trade, somebody is using it, I am making money. All right, when they pay back, it comes back to my stock in trade. I give it out to the next person, I'm making money. If it comes back and sitting there, I'm not making money. In other words, look at the money in the bank as something that is never should be there. It should be rolling. It should be rolling. And rolling here in money, in the language of banking, you don't take physical cash and go. All right, it's the credit creation that keeps it rolling. The credit is banked on your money that you have there. Okay. Anyway, just to touch on it a little bit, but we're not going to the banking section. Then we will start another session already. All right, moving on. However, MFRS 107 notes that there is no consensus on the classification of cash flow for either entities and suggests that interest may be classified either operating or financing. Now, in the example that I gave you, the word may be classified is non-existent, because definitely one is a financing transaction. You cannot say the financing transaction is investing. No way. All right. So likewise, the investing one cannot be financing. There's only gray areas that you might have this problem. All right. So interest received and dividends received may be included in either operating or investing cash flow. So interest received, let's understand this. You have spare fixed deposit, you put it in the bank and you earn some interest. Okay. Now that money that you put in the bank is actually part of your working capital, but you're not using it. You're not using it for now. So you put it in the bank and then you earn the interest. Is that investment or is that operating? I will lean towards operating, because that money, the mother item that you had, the cash, was actually to buy stocks to run the business. But because right now you got some money, you don't want to use all of it, you put that to earn interest. So whatever interest goes in is operating. It'll be operating, not investment. Now let's take another scenario in the same company. There is a lot of money already generated. We don't need all this money for using now, but just in case 2-3 years we need it, let's put the money on fixed deposit. All right. And then we put that on fixed deposit and we earn interest income. What is the intention? The intention is to earn interest income, right? So that will be definitely investment activities or financing activities, right? That's what it will be. Or you give a loan to a related company. You got extra cash, related company not doing well, or the subsidiary is not so doing so well. So you don't want to, to collapse the subsidiary and keep your money in the fixed deposit. So you loan it there for them to roll. Now that is also investing. All right. So that's how you need to understand the background of information before anyone makes a judgment. So you see, when we look at the cash flow statement standard, it's basically a very simple standard. Obviously, when we look at the standard, nothing in the cash flow one, just remember where to put the thing. No, it's not to remember. That's why I thought when MIA also was talking about this, this is a good thing for everyone to be aware of. All right, because there is more than meets the eye, and that thing that meets the eye is very shallow. So it's good if the students can be given all of these kind of information when they learn. Maybe they will look at cash flow statements in a different light. All right. Okay. MFRS 107 allows dividend to be paid, if dividends that are paid, to be classified as a financing cash flow, because they also say dividends are a cost of obtaining financial resources, or as a component of cash flow from operating activities. Now, it says you can classify dividends as financing cash flow, all right, rather than putting it as a distribution of dividend. But most companies do not do this. Most of it never put in financing cash flow for very obvious reasons. Because when you put a financing cash flow, people think that, oh, you are getting some kind of financing from somewhere. So if it's your own free flow funds and you are actually receiving these funds, free flow funds and putting on fixed deposit, why would you want to put it as a financing cash flow? All right, dividends paid. This dividends paid, sorry. If you receive money in the form of equity, all right, whatever form of equity. But if you say that it is redeemable preference shares, redeemable at the option of a holder, the mother transaction is a financial liability under MFRS 9 or IFRS 9. And because it is a liability, you cannot then say that this be called something else. So dividend must be classified as financing cash flow. There's no two ways about it. But dividends for ordinary shares, it is very ridiculous to consider as financing cash flow, because the reader of the financial statement may get a wrong idea. But then again, when we talk of dividend, there are all kinds of structures of money that you can get. In today, you can structure your capital in many different ways. So it depends on how the structure of the capital is, whether there's a potential to return that will trigger financing cash flow, in my opinion. Okay. Now, taxes on income. What about taxes on income? What's going to happen there? So cash flow on taxes on income should be separately disclosed with operating cash flows, unless specifically identified with investing or financing activity. So most taxes on income is always operating. You earn money, you pay the tax. As I said this morning, maybe you sold a property and you got RPGT on it. Well, yes, you can put as RPGT relating to that particular investment. You sold the investment, so you get, tax. You can do that, nothing wrong. But there's nothing wrong to put it in the default bin. Remember the default bin? So put it into operating is fine. And most companies you will observe, they will put into operating. First, it's cleaner, it's easier to understand, because the amounts involved on the others normally are nowhere as significant as income tax. Income tax, if the company is big, will always be significant. All right. Now, where it is possible to match the element of tax expenses to transaction for which the cash flow are classified under investing or financing, taxes paid are usually classified as cash flow from operating, because it's often impracticable to match cash flow to whichever element. And that I totally agree. Right? It's impossible. And secondly, it's a waste of time. Thirdly, no investor gets any additional benefit of assessing this, where it come from. All right? Nothing. So if it is going to be of negative use to people, then follow the default bin. Right? Now, also those tax cash flow that may arise in different periods, all right, from underlying transaction. Sometimes taxation may stretch here and there. Sometimes they may have, back taxes, whatnot. It all goes into the current period tax, current period operating. All right. So no such thing as, oh, we didn't pay. The IRB, the Inland Revenue Board, came and did a tax investigation on us or a tax audit, and then said that 3 years ago we underpaid the tax. So now what do? We're going to go back to 3 years ago and adjust it? No, we do it now. All right. Because if we adjust it 3 years ago, then the thing is going to be very messy again. All right. So it's not something that you want to do as a prior adjustment, but there are people who will do it as well. Okay. Now, cash contribution to a long-term employee benefit fund. These are called retirement benefit fund. Some companies, especially the older companies, today, not very many companies go for retirement benefit fund. They rather you put in the EPF and then you manage your own thing. Because retirement benefit fund is very late change. You got to value it. But olden day people or the older companies, for that matter, had that. Or sometimes high risk jobs, like you're working in deep mines, or you're working underground, or you're working under the sea doing oil exploration and that stuff, that will be another. They will create a fund for you because they are high risk jobs. Anything can happen. All right. So they will get for those kind of people. So the definition of activities under MFRS 107 includes cash payment to and on behalf of employees. Now, when you pay to and or you pay to anyone else on behalf of employee, such cash outflow normally involves wages, salaries paid to employees, and taxes paid on behalf, including EPF, because you have to deduct tax. The employer must deduct tax. And any other employee, the benefit or contribution is for the employee. Now, where the company makes contribution to long-term employee benefit, all the others are operating. Where you're making on long-term on behalf of the employee to a retirement benefit fund, those cash flows are part of the compensation for employment and will therefore be an operating cash flow. So logic, I employ the staff, terms of employment. If you work in this company for 30 years, you will get $500,000 as your retirement benefit. All right. So if you work for 30 years, then the cash is there for you to pay. Now, where do you charge that every year? Because every year is working, is an accrual there. All right. There's a method of calculating. Normally, an actuarist will do the calculation for you. So when these are charged to the P&L account every year, they are considered operating because the staff working for you is running the operations of the company. All right. So he's not a financing fella. He's not an investing fella. So it is operation. So they are only operations on the principal revenue producing activity. Now, what about factoring trade receivable? Many companies, they have trade receivable, wait for 3 months or 5 months or 6 months to collect the money. Now, what happens if I take my trade receivable and sell to the bank at a discount? I get cash immediately. I can now buy more goods. All right. So trade discounting, or rather trade, debt factoring. All right. Debt factoring. How do we handle this debt factoring? All right. You sold it to the bank. But when you sold to the bank, you have a continuing liability. Because if the debtor don't pay, the bank is not as clear. Oh, the debtor didn't pay. Never mind. We give you the money. Okay. No such thing, right? They will say, that debtor you didn't pay me back that one. Why? They want the money back. So now you have a continuing liability. Now, how do you show this in the cash flow statement? Are you liable or not liable? Have you sold it or not sold? You see, there is a confusion. So let's look at it. In the case of debt factoring, an entity aims to provide cash flow from the trade receivable more quickly than will arise from normal collection from customer, generally by transferring the rights of those receivable to a financial institution. All right. So the right to receive from this thing goes to the bank. So the bank takes over, but they paid you already in advance. Discounted value. Nobody's going to pay you the full amount, right? To you, it doesn't matter. If I borrow money, I also pay interest at more or less that kind of discount rate. Maybe this one is slightly more. Time value of money is important, right? So the classification of the cash receipt from the financial institution depends on whether the transfer results in really a derecognition of trade receivable. Can I say, Mr. Banker, you paid me 100,000, I got 100,000 receivable, here you take and go finish, done deal. You paid me 90,000, I'm fine with it. Any problem with the receivable, yours. Can I say that? All right. Can I say that? All right. So therefore, in the debt, the aim to provide cash flow from trade receivable quickly that will arise from normal collection, generally by transferring the rights of those to the financial. But remember, the classification of the cash received from the financial institution, they pay you the cash 90,000. Debit bank. Credit what? Credit the trade receivable or credit something else? Or credit the bank? Which one? All right. Depends on the transfer, whether it results in a total recognition of trade receivable or to be continued. You keep recognizing your trade receivable on the and also you recognize the financial liability for the funding until all the debtors are paid. That means trade receivable 100,000, leave there. Banker says, I take over your rights on whatever you collect from here. The rights. That means whatever you collect, send to the bank. But you keep the receivable, you collect first. Okay, and then send it to me. But I will give you money, 90,000. Debit bank, credit the financing on the current liabilities, all right? Amount due to the bank on trade financing. So that liability is there, the asset is there. So that's why you're talking about the classification of the cash receipt from the financial institution, debit bank, credit, trade receivable, depends on whether the transfer of this receivable results in a derecognition. Do you take receivables out of your books? That means you will debit the bank, credit, trade receivable out. All right, or to the continued recognition of trade receivable and the recognition of that financial liability, the trade payable, for the funding received for the factoring entity. All right, we have to establish that. Now, to the extent that the factoring results in a derecognition of the original trade receivable, take it out, then it is, you can regard the cash receipt in the same way as a receipt of goods. And therefore, whatever you receive is as if the trade receivable paid you the money already, and therefore you can definitely say it is an operating cash flow. Now, if the trade receivable is not recognized and you set up a parallel debit bank, credit, trade payable, all right, trade finance payable, all right, is a liability recorded, and the nature of the arrangement is in substance a borrowing that is secured against your trade receivable. So the cash received from factoring should be treated the same way as a short-term borrowing. So what is a short-term borrowing? Financing activity. So you see how complicated it can become on some transaction. And everybody must know what is that. Now, it is now 3:30. I believe we are following the normal webinar. So 3:30 to 3:45 will be a tea break. So if I'm right, perhaps you can confirm this, and I will hand over to MIA. Okay, let's continue. Before I continue, I would like to address the questions that are on the screen. I think there is one question. All right, so let me see what that question is about. Dividend paid on redeemable shares, redeemable preference shares, redeemable at the option of the company. All right, so that's like equity, right? Is classified as investing. Dividend paid on redeemable preference shares at the option is classified investing. Proceeds from the issuance of ordinary shares and dividends paid are classified as financing. No, it's not a correct assessment. Did I say that? Maybe I made a mistake. Did I accidentally say that? I may have. Actually, redeemable shares at the option of the company is exactly equity. So because it's equity, it's just like shares, all right? So it is classified as financing, because always shareholders who give money to the company, ordinary shares or preference share, is always called financing activity. Although they are not in the true sense of the word financiers, they are actually financing the company, all right? So therefore, the first sentence is not quite correct. Maybe I said wrongly. If I have, I'm sorry. It should be actually redeemable preference shares is under financing, same as share capital. All right. So proceeds from the issuance of ordinary shares is financing. Dividends paid are classified. Dividend paid is classified as depending on what the money is used for. So if it's for normal financing, yes. I mean, for normal operations of the company, because the money came from the shareholders, it's financing. So it's correct to say financing. All right. Now, let's look at dividends, preference shares at the option of the holder. This is like a term loan. So term loan, the money comes in, you also put as financing. When you pay the interest, it's charged to P&L account, is also put as financing. All right. Now, unless you think that this money you took is for your operational purposes. All right. So redeemable preference share at the option of the holder, it is like you can treat it something like what should I say? Financing, not financing, to run your normal operation. Then, in a very rare instance, some people will charge the interest paid to operating cash flow. All right. Now, that is very rarely done. But as I say, that could be the default. In most instances, both preference shares, option of the holder and option of the company will always be inside financing. All right. I hope that clarifies, clears the air. If I made a mistake, sorry, but this is the amount that it should be. All right. Any more questions? Never mind. All right, let's go. Thank you. Okay. Right, let's proceed to the last part of the show for today. Okay. So we just stopped on this slide. Let's carry on. So allocating items, we are still on the topic of allocating to either operating, investing, or financing. And these are contentious items. Cash flow from, now there's a new kind of thing that the bankers are doing, that their financiers are doing. Supplier financing and reverse factoring. Now, because at that time, when the standards came out, this form of financing was not yet prevalent, and so it did not come up with any issue. But now, in recent years, there has been an increase of what they call supplier finance arrangement, in short form SFA, or commonly known as reverse factoring. All right, look at all this nowadays, the reverse factoring. That's why the financial markets can grow, because all kinds of funding exists. All right, and so this arrangement have never been done before. How do you account for it? So the International Accounting Standards Board had issued an amendment called Supplier Finance Arrangements on the 25th of May this year, 2023. Then the Malaysian Accounting Standards Board, the MASB, also on 30th June 2023, not so long ago, published the equivalent amendment to MFRS 107 called Statement of Cash Flow. All right, that is a standard. And also on MFRS 7, Financial Instrument on Disclosure, requiring specific disclosure on supplier finance arrangement. So this is something quite new. Most likely students would not have heard of this. So these amendments, when you talk about cash flow from supplier financing, or sometimes called reverse factoring these days, the amendments describe the characteristics of the supplier financing as an arrangement where what happens, let's see what happens, where, sorry, I turned my laser pointer, in which one or more finance providers offer to pay the amount an entity owes to the supplier. So finance people say, okay, I pay the supplier, don't worry, you pay to me. Okay, and the entity agrees to pay according to the terms and conditions of the arrangement on the same date or at a date later than the supplier. So it's like this. My payment to my supplier, this is not receivable, this is paying. So paying will be reverse factoring. Receivable is factoring. Payable is reverse. So I've got to pay in 60 days' time. All right. So what the supplier will do, or what the supplier financier will do, is that he will say, I will pay now. You pay me in 60 days' time. All right. That means I don't pay the creditor. Creditor is done and paid. So I have a choice now. I can now order more goods from the supplier and sell and get more money. And same time, I can be paying my same creditor that I'm supposed to pay in 3 months' time. I now pay my supplier in 3 months' time. But I got one more round of additional facility. Now, that's why it becomes popular, right? So that's why I say using financing sometimes can help the company to go very fast. So let's carry on. So what happens is the finance providers offer to pay the amount to the entity that the entity owes to the supplier, and the entity agrees to pay according to the terms and condition of the arrangement on the same date or even later date than the suppliers are paid because they are the financier. So they charge the interest. Now, this arrangement typically provide the entity with extended payment terms or the suppliers or the entity suppliers with early payment terms compared to related invoice payment date. So I can do another thing now. You see, if I am the company and I want to buy goods, I always take 60 days credit, let's say. Now I can negotiate with the supplier. Mr. Supplier, I will pay you immediately on cash. I want a discount on my goods. So I will get probably a 5% or 10% discount on my goods. All right. For early payment, prompt payment. So my supplier financing will pay. So I've got 3 months to pay still, but I pay the supplier. So I agree with the supplier, I only pay you 4% or 5%. So I make a difference of 5%, right? So I bought the goods at a discount of 10%. I'm selling at a normal purchase price. So my margin has increased. I make better profit. The financier gets a little bit of it. I also get it. And then I can make another round of purchases, and then I can increase my business volume. How nice is that? Wonderful, right? So this is called supplier trade financing or reverse factoring. Now, bankers do give this trade bills, but they are not as flexible like this. So this is more popular. So the arrangement typically provides the entity, the company, with extended payment terms or early supplier or early payment terms. You can pay earlier, get a discounted value compared to the invoice payment due date. So what are the amendments made by IASB onto the cash flow? All right. So under the amendments, the entities that enter into a supplier finance arrangement need to disclose the following: the terms and condition of the supplier finance arrangement, and also a supplier finance arrangement that have different terms and conditions. You must disclose them in the notes. The carrying amount of the financial liabilities that are part of the supplier financial liabilities, because don't forget, when you pay the creditor, you're owing the supplier finance, right? He paid you the money, debit bank, credit supplier. So supplier financier, sorry. Okay, so you need to have that carrying amount of liabilities that are part of the supplier finance, and the line of items those liabilities are presented. The carrying amount of the financial liability, the part of the supplier finance for which suppliers have already received payment from the finance provider. So you need to also state these additional things in the notes to the accounts. All right. Now, the range of payment dates. I don't know what this thing. Yeah. Why I got N3, N4 here. I don't know what happened here. The range of payment dates for both the finance liabilities that are part of the supplier finance and comparable trade payables that are not part of the finance. Please delete this N3 and N4. It doesn't, I don't know what happened. Maybe I was typing and something got into the way. And the fifth one, the type and the effect of non-cash changes in the carrying amount of the financial liabilities. And these are stated in paragraph B44H of the amendment of MFRS 107. And the liquidity risk arising from the normal SFA, concentration of risk with one finance provider. So here again, the normal risks are stated accordingly. So access to the supplier finance arrangement are also included as one relevant factor that the entity might consider in providing a description of how it manages liquidity risk. All right, and that's paragraph B11F of the guidance, as well as the actual MFRS 107. Sorry, I didn't put the 10. It's actually MFRS 107. All right, the new disclosure will be effective for reporting periods from next year. You can have early application. So these are merely something new in the terms of reverse factoring. Receivables is factoring, creditors is reverse factoring. Okay, so interesting things. All right, now that is basically all about cash flow and cash flow statement and all of those things. What I'm going to try and go through quickly here is the next few slides is about understanding cash flow and profit. Now, this is the actually a background information. All right. It can be directly or indirectly related to cash flow. This is something, if you like to explain to the students, it'll be good. But this is slightly outside of MFRS 107. All right. I will go through it very quickly for that. After that, we are going to go through that working sheet. So I will try to finish as quick as possible. So then we will go through how to do a cash flow, a very simple one, because I don't want to put complicated things here. And then we find that we are taking up a lot of time. I'm sure for students, the basics are very important, and that's more enough. In fact, I covered a lot more than the basics today, which a normal student would have learned and come. But I think you need to get more information in order to be able to explain. So this is very quickly I will rush through. All right, cash flow and profit. Now let's look at it. What is the difference between a cash flow and a profit? What is the difference? Most of us know, but let's reinforce our thoughts. All right, cash flow is constantly moving in and out of a business. Cash flow, all right, not physical cash, cash flow. When a company purchases inventory, money flows out of the business towards the supplier. Out it goes. When that same company sells something to from the inventory, cash flows in from the customer. Then in it comes back. Obviously, what comes in and what goes out, there must be a difference. Otherwise, you are running a business at a loss. All right. So when the retailer pays a salary to the staff, expenses, cash flows out of the business. So you don't need to flow, sack the staff. Sack the staff, business will close. Nobody to work for you. All right. So it doesn't work that way. Okay. So cash flow refers to the net balance of cash moving in and out of the business. That is the cash flow. All right. So when we are looking at the 107, that we are talking at cash balance at the beginning, cash and cash equivalent balance at the end. This is the net balance out in and out. Cash flow can be positive or negative. Which would you prefer? Negative or positive? We all like positive, right? Now, negative not always means bad. Right? If you have an overdraft to expand your business, it's not always bad. So again, case by case. Positive cash flow indicates that the company has more money moving into it than out of it. Is it good or bad? Technically good, sometimes too bad. Because you're keeping money for what? Money must be used to work. Money must work itself. So if you got money, increase your purchases, sell more goods. If the market is not there to accept the goods, change line, do something else, invest in something else, right? Negative cash flow indicates that the company has more money moving out of it than into it. So what is a profit then? We can identify what profit. Profit cannot be seen or touched. It's defined as the balance that remained when all of the business operating expenses, not the cash flow, the expenses are deducted from revenue, not the cash income, the revenue. Profit can either be distributed to shareholders of the company in the form of dividend payment, or it can be kept and retain earnings and the money reinvested back into the business. So if you don't distribute the dividend, where is the cash? The cash is inside the company. So you can reinvest back. Retain earnings still there, but cash has been gone already for reinvestment. You buy machinery, things like that. So you see two running parallel. So retained earnings might be used to purchase new inventory for a business to sell, or used to finance R&D work for new products and services to keep the business competitive. One of the key points in any business is always to have sufficient R&D to survive. Whether you are a manufacturing company, whether you are a trading company, or even whether you are a kitchen, a bakery or a restaurant, All right. How many people, how many times you go to a restaurant, every time is the same food, same food, same food. Yeah, let's go try the next one. Now, if the restaurant periodically changes their food, then you say, hey, there's something new here. There's something new here. So it does not only relate to trading or manufacturing, even to this. Just look at Apple, how much money they put into R&D. And every time we get a new phone, it's technologically superior than their own existing phone. Where are other companies? What happened to Nokia? Once upon a Nokia was the king, as I mentioned before. Today, you never heard of it. Nokia was sold to, I don't know which company it was, right? And they even closed it down. Okay, I think Microsoft or something, they closed the whole branch down. So now whatever is being manufactured only some kind of thing for the Bangladeshi. These people were king. Why? They could not keep up with the investment. So there's a life cycle of the product. So one of the things to maintain profitability will be obviously to make sure you finance R&D work for new product to keep the business competitive. Like cash flow, profit can be shown as a positive number or a negative number. Now, unlike cash, right? Positive is good. Negative profit is no good. Right? Cash negative can sometimes be you are on an overdraft to improve your business. So when this calculation results in a negative, is referred to as a loss because the company spent more money operating than it was able to recover. And like cash flow, profit can also be broken down into three categories. Gross profit. This is the top line profit. Revenue minus cost of goods sold. It includes variable costs. It does not include fixed costs. All right. So this is the variable part on the gross profit level. Fixed costs will come after. All right. So variable includes absorption, costing, and all that stuff. We are not going to that area. Like operating cash flow, operating profit only refers to net profit that it generates from normal business operation. So a company can also have investment income that becomes also a part of their profit. So excludes negative cash flow, tax payment, interest payment on financing. Exclude positive cash flows from areas outside the core business. Those are referred to as earnings before interest, tax, and interest and tax, EBIT. All right. So all of this excludes all this cash flow, negative and positive, like the operating cash flow. But this one excludes negative cash flow. So that is called operating profit. All right. Net profit after tax, or NPAT, as we normally say, net income after all expenses have been deducted. This is the net profit after tax. So it includes expenses like taxation and interest expenses, everything in there. Cash flow versus the profit. What is the difference? So the key difference is profit indicates the amount of money left over after all the expenses have been paid. The amount of money, all right? But cash flow indicates the cash, the flow of cash in and out of the business. Money is the numbers. Cash is the physical amount. Although it may not be physical cash, but it's sitting in your bank account that you can actually use. The amount of money in the profit and loss account, you can use to distribute only if you got cash. If you got no cash, you have a big profit, you cannot distribute, right? So it just indicates how much is left over after the expenses have been paid. It does not represent the cash at all. So both which is more important? Very interesting question, right? Cash flow or profit? So the profit and the cash flow are important in their own ways because both are interlinked one way or another. No such thing as they are different, all right? You don't generate a revenue, you don't generate cash. So are important in their ways in order to assess the financial health of the business. Example, it is possible for a company to be both profitable and also have a negative cash flow. And that's what I said just now, all right? Which prevents the company from being able to pay the expenses, expand, and grow. It's also possible for a company with a positive cash flow and increasing sales to fail to make a profit. Why? You're having too much expenses, right? And also Many startups and growing business fail along the way. So you see, it's possible to have a positive cash flow, yet you fail. So one alone is not enough to assess the health totally of a business. That's what, as I mentioned in the first time, early morning. All right, you need both. Actually, you need the balance sheet as well. All three play an important part because everyone has got their own function. All right, one could be function of a heart, one could be the liver, one could be the lungs, one could be the kidney. Now, this is the way everything becomes one, right? All right. Without now management's framework to a profitability and also a positive cash flow, without an effective cash flow management system in place, which is our cash flow statement, a business will fail within a few years. Now, these are all statistics. 60% of new businesses fail because of profitability and because of cash flow. All right, two things they fail. 60% fail. The following should be the framework set up by any management to increase profitability as well as improve the cash flow. Number one, understand that if you make a profit, it does not mean you are making money, or rather you're not having enough cash. It does not mean you'll automatically, the cash will drop from the sky. So many company management wrongly say that cash flow and profit is the same. If I make a profit, I got cash. Where does the cash come from? As I said the very first morning, you can sell and sell and sell. But if you don't collect, tak jadi. Okay? So number two, sorry, yeah, this is the same number one here. Continue. Understand it's not possible to analyze cash flow just by glancing at the profit and loss account. Take a peep. Hey, got profit, huh? That is, a very, very surface look. So multiple factors make up cash flow: inventory, income tax payments, operating expenses, accounts payable, accounts receivable. There's an interplay. If you can't collect your accounts receivable, you can't pay your accounts payable. You can't pay your accounts payable, you don't have enough inventory. And your operating expenses, if you don't manage your operating expenses, it is bloated. And this is what causes the cash flow issue. All right. So one is a P&L item causing a cash flow issue. So effective cash flow management to be carried out, you must individually dissect each of these here. All right. With the profit and the loss. Profit is simply defined as revenue less expenses. That's all. So you cannot assess the flow of cash in a business by knowing how much profit it made. So liquidate surplus inventory that are unusable or inefficient. Many companies like to keep old things. All right. Unsold inventory or surplus inventory. What is happening in the cash flow side? Money is tied up. All right. Once the cash flow is tied up there, you have no cash coming out. So this will be unusable PPE. Cannot use old machine, just leave it there. Even you sell to the scrap dealer, you get cash. But many businesses don't manage the cash flow, so they don't know. All right. And some directors are, no, like keep for one day, keep for what I don't know. Right? They tie up capital which could have been used more productively. So such PPE may have a book value equivalent to less than the net realizable value. Yeah, the book value is 100 ringgit, net realizable value only 30 ringgit. So some director will say, yeah, what for sell for 30 ringgit? Don't waste time. But that 30 ringgit will free up your space for your whatever machinery you're keeping. I'm just talking a figure. And you can use that 30 ringgit for something. Let's say it's 300. Let's say it's 3,000. Now, all that is money. You put money in a fixed deposit, you get 1,000, you get 500. You say, hey, well, make money, But here, 3,000, you don't want. You see, this is where cash flow, is very inconsistent with the profit. And the machinery may be there. You are depreciating the machinery still. And the depreciation is going to P&L. Profit is going down. Apa ini, right? So it's disposing such PP will realize cash flow, and the business could be used more productively, the cash. So customer demands and requirements change all the time. This is something that we must be very aware of, any businesses. You cannot say, I've been selling this for the last 50 years. All right, 50 years, people buy that. Now, some people, at one time when fax machines came into the market, there was such a great demand. I remember there was a 1980 something. I wanted to buy for my office. It was so difficult to get the waiting list and all that. What happened to fax machine? I never heard of them anymore. Do you put a fax machine on your phone? Maybe some big companies do. Lah. Nowadays it's all email. Everything is scanned. The whole thing has changed. All right. So customer demands and requirements change all the time, especially when new products or material enter the market. Therefore, inventory that are not sold become outdated. Sell them as soon as possible. Improve your profitability. Improve the cash working capital. All right. Another way to increase the cash flow is to add new source of income, adding new products or service. Now, you got to drive this in order to improve your cash flow in the statement of cash flow. You see, this is together, how nice if everybody understands it together. But some businessmen don't understand this really, but they learn from common sense. No money, how? All right. So brainstorm new products and services that will be a great addition to what the company is currently offering. New products will ideally complement the existing brand identity, and management must understand the needs of the target market, the likes, the dislike, all right, all of these things in order to drive the cash and drive profitability. You need to drive two things. So that's why when students come out to work, they must be very gung-ho with all this principle. Then they can pick up faster. Doesn't mean if they learn, they automatically come out, but they have learned there's something in their subconscious mind, which they may have stored. And when they come across it, now I realize what it is. Okay. Rather than, hey, what is all this? I don't know. What's cash flow? What is profit and all? I don't know. You tell me. This is a crazy thing, right? So creditors, credit period, and prompt payment discount. Here's another thing just now I told you. Payment to creditors can play a significant role in the cash flow. Some suppliers offer discount for early payment, and this adds to the bottom line profit. Remember, now the supplier financing arrangement, SFA, if they pay immediately, you can ask for a better price, lower discount, your profitability increase. All right, it's all the way success. And for credit purchases, negotiate the best credit pay available. If you really need and you don't have supplier credit financing, all right, supplier financing arrangement, sorry, you probably ask for a longer credit period. So that will enable you to collect and pay the creditors. You have a better rolling cash flow, all right? And therefore, when the corresponding debtors, the receivable, they pay you in 30 or 60 days, you got a buffer there before you pay them. In case anyone delays, you don't have a crunch in the cash. Cash reserve to manage the cash flow. Having a cash reserve can actually bridge any gaps in a cash flow. Or that's why you store your funds in short-term deposits. When you need it, you take it out and use it. So that's where this one ties in with what we said just now. Applying to the bank for a business line of credit like overdraft or other trade is an established way to build a cash reserve. Only by using their money, you generate profit, pay them their interest, pay them the loan, and then you carry on and the thing will start running, right? Now, revolving credit facilities are even better, all right? They can be drawn when needed without incurring interest when not used. Overdraft will have commitment fee, but revolving credit, when you download, you pay. You pay a slightly higher interest rate, but when you don't use it, you don't pay any interest. So there are all these things that you need to understand how to make profitability in terms of interest and how to generate cash in sense of using other people's money. That is the bank's money. Right? The facilities can be used to pay the business expense and pay off immediate debt, taking advantage of discount and prompt settlement. When cash is received from a receivable, they can be used to pay off some of the debts and the bank facility. So here is how you try to manage it. And then you go back to the profit and loss account and the cash flow, your statement. And then you can see how you drive the cash flow. So cash flow and profit, keep the operations lean. Evaluate the business, see if it's necessary to incur an expense, hire a new employee or purchase new expense. Don't be so flamboyant to employ people easily. Some people like to say that, oh, I got so many staff, so many staff. But are they actually profitable? So some business get caught up with the excitement of starting a business, that the thin line between what you need and what you want has all blurred together. Okay? And before making a new investment decision, weigh the pros and the cons. And that will help cash flow retention by avoiding unnecessary expenses. All right? Implement proper and efficient credit control. So typically, a business must wait for 30 days, 60 days, or even 90 days before customers pay the invoices. Now, it is a psychological thing. If you keep reminding customers, phone call or give something, many customers will not pay on time. They always pay on a need basis. If somebody chase me, better pay him first. If somebody don't chase me, well, let him chase first. All right, this is the philosophy. Those are a lot of businessmen do that, but a lot of businessmen pay on time. They tell you on the 25th of the month, the money will pay and you'll be paid exactly, all right, or 27 or whatever. So late paying customers can cause the cash flow of a business to go haywire. True. I've seen that in practice so many times. So regularly reminding customers or giving incentive for early payment when they or special offer on the next payment if the purchase is made on time helps a lot in collection. Collection is very important. Your cash flow statement is nothing without collection. Apply for trade factoring facilities. This on the receivable side. So if immediate funding is needed, invoice finance, oh, sorry, this on the creditor side. Trade factoring, this is what the bankers give. Now you got supplier financing already. All right. So that is another new one that has come up. It's very popular and effective to cash flow. Invoice financing allow business to sell the invoices to a bank at a discount. Banks will normally give financing up to 80% of your invoice price. So you got cash to roll. All right. So important to have the cash to roll. And that will make a better cash flow as well. So the balance of 20% will be received once your customer pay the amount on the due date. So you will collect, they will pay 8%, then the interest is charged. You just pay them. When the customer pay you back, the 20% is yours. The 80% you pay back to the bank. All right, cash flow will be freed up effectively, and the business has in effect collected the cash from pending customers. All right, now let's we have yep.
Nak balik dah.
Hello? Yes. Somebody's calling. Anybody? Nope. All right. Maybe there's something else. Now I will go on to the worksheet. All right, and try to look at the example that we are going to go through. All right, so let me just get out of this and what's that? All right, put on the next one. You look at your spreadsheet that you have. All right, let's make this bigger. So this was the question, simplified one that we looked at to try and do a cash flow projection based on this simple plastic building materials company. All right, so this particular company has got the following balance sheet. So you have cash and bank balances, marketable securities. Now this could be both, could be actually cash and cash equivalent. If it is very easy to get rid of it without losing anything with a low risk, it could be like government bonds, then these are called equivalent to cash. All right, cash and cash equivalent. Trade receivable, other receivables, unquoted investments, property, plant, and machinery. And also you have on the other side, the trade payables, other payable, current tax, deferred tax, and all that stuff, and the proposed dividend. So this is the balance sheet, and this is the profit or loss. So the profit or loss has sales, we have purchases, and then you have the all the expenses, etc. And they are making a profit of 600,000. All right, so movement in the retained profits. So balance brought forward, unappropriated profits, proposed dividend, and the total. Net profit for the year, and then the dividend paid, prior year proposed dividend paid already, and then current year interim dividend, and then proposed dividend for the current year. All right. So all of this will already become liability and paid. So this is the balance carried forward. All right. So further notes, during the year, some property, plant, and equipment with a net book value of 80,000 was sold for cash, and it was 50,000 was received. All right, 50,000 was received from the sale. The freehold property that they had up here, which is a freehold property, right, just to be sure that they have it. So this property, plant, equipment includes a freehold property. So because it's not possible to replace to put everything in a training, so we put and we just understand it now. So the freehold property was sold for cash for 50,000, 50 actually 50 million, all right, 50,000, whatever, all right. And the freehold, sorry, property, plant, equipment was sold for 50,000, and the freehold property was revalued upwards to 100,000, and the surplus, because it's PPE, credited to other comprehensive income and retained in the revaluation reserves in the statement of changes in equity. Now, the gain arising from the sale of a patent, they got it for cash consideration of 200,000. Marketable securities, which consist of market instruments, were part of the company's cash management and are considered as cash and cash equivalent. So we will need to, in the circumstances here, consider both these items to be cash and cash equivalent. All right. So having said that, let's prepare the cash flow statement of Polyplastic for the year ended 30th June 2023. So this is the question. I've not given you this, but together with the Polyplastics accounts, I will also send this to you. All right. This is the statement of cash flow. So now let's look at it one by one. We will go a little bit slower here. This is important to understand. So the profit before taxation will have to, the profit for the taxation, make the adjustments for depreciation. All right. Sorry, this figure is actually up here. All right. That's why something went wrong here. So this figure is actually up so you can read better. Right. Okay. So profit before taxation is 900. Where do we get that? We get that from the accounts here. All right. Profit before tax. Maybe I shall put a small light, what should I say, shading here. Yeah. So this is the profit before tax, and we start off with the profit before tax here. Right? Oh, sorry. Okay. Then we have adjustment for depreciation, non-cash item. Take out the non-cash item. So 160,000 is the depreciation, which was given in the whole thing here, somewhere on the profit and loss, I believe. 160, I saw it somewhere. Where is that? Sorry, I'm moving up and down to check where the figure is. I saw it and I suddenly missed it. Right, must be in the, cannot be in the balance sheet, so it's in the P&L. Yeah, 160,000. All right. So let me just also put that as a item here. So 160,000 will go into this as well. All right. Adjustment for non-cash item. Loss on sale of property, plant, and equipment. Now, the profit already has a loss inside, deducted. Now we add back the loss. Add back the loss. That's why there's no minus here. All right. Interest expense is 30,000. It's not that interest expense is not a cash flow, but it is not a cash flow from operating. So we want to regard this as financing. So we take it out. All right. Also interest income. So minus out the interest income, which already went inside the P&L. So we take it out also as part of financing. Okay. And the dividend income, we receive dividend income. So if we receive dividend, it's probably from an investment. So it's probably investment in the cash flow, right? It will not be in terms of the operating profit. So the real profit before tax, as shown in the accounts, in order to arrive at the real profit, after adding all these items, we will get the operating profit before, remember just now I say, working capital changes. Now we look at the current asset and current liability. That basically is the working capital. So working capital changes will be either increase or decrease in trade and other payables. Receivable. So in this case, when you have an increase in the asset, what does it mean? It means there's an outflow of funds. That means you have given credit to a customer, he has not paid you. So from the working capital change, we put on 170,000. All right. An increase in inventories because we bought additional inventory. All you need to do is compare last year and this year. All right. So all you need to do here is on the balance sheet, you compare the two. All right. So you see inventory has gone up and this trade receivable together have gone up. You just compare the two, and that's where the figures are coming from. It's not rocket science. Huh? Okay. So then you have the increase in trade and inventories, increase in trade and other receivable, and increase in trade payables. All this come from the balance sheet. Okay. So operating profit before any working capital, there'll be 1,070,000. Now, what you have is working capital changes. Some are debtors, some are creditors. You're often knocking off. The cash generated from your real operation is not 1,070,000, it's not 900,000, but actually it is, sorry, all right, the figure is 920,000. Maybe I will put some other color here. Let's put a brighter color so we can identify this is cash actually generated. Now, from that cash that was generated, we have paid out interest, all right, of 30,000 for the year. We also paid a tax of 100,000. If you go upwards, you can see it there. All right. Let's go and look at the interest paid. So if you look at around here, they have some notes which they tell you. There are no notes. You can see straight away in the P&L account. All right. Interest expense is 30,000. Interest income is 10,000 for the year. All right, so that's where we will be looking at here. All right, interest expense is 30,000, and then interest income is not inside here. Interest income is here, 10,000. All right, so therefore, we have already determined what's the working capital change. Then the trade and other receivable, we get the cash operation, and then the interest paid, the interest received from another place there on this thing. Sorry, tax paid, not interest. My side crossed. Okay, 100,000. And then you have interest received. Remember just now we said that. So that also goes in there. And then you have dividend received. So from your operation, because dividend is an operation income here, you invest in something. If you want to treat it as operation, then you treat it as operation. If you want to treat it as investment, you can treat. There is no hard and fast rule. All right. So this one is 40,000. So you get 840,000. All right. That's a net cash from operating activities. What was the original figure? 900. After that, you really find that you only get a net cash of 840. Then you look at the cash flow from investing activity, purchase of quoted investments. So now the quoted investment generated revenue. Now that revenue, if you are using it in the form of dividends for your business, then you treat it as part of operating. That's why the dividend went inside here in operations. You see, it's all about judgment. Okay. Now, next one is, because the thing is, what are you using the dividend? It goes into the general bank account, and the bank account is being used. All right, the dividend inclusive. So it's made for operations. So it's used. But if it goes into a separate bank account, investment funds, then you will put it under the investing activities. So again, looks at the operations, So it is a It is not a hard and fast rule. That's why they are contentious item. How business treated is not whether it's wrong or right. It's about how I use the money coming in. If I keep it aside for an investment, I have a special separate investment account, then it will go into investment. It comes into investing activity. If it goes into my general bank account, payment of creditors and all the expenses come from there, what is it? It's operating. Okay, that's the criteria. All right, so then the proceeds from the sale of plant and equipment, yes, then you have purchase of quoted investment, which you saw just now that we purchased, and also purchase of property, plant and equipment. We can see that here. All right, so purchase of property, plant and equipment. Yeah, the net value was sold for cash, and actually it was revalued, and there was a purchase of property, plant and equipment for the year, which I saw somewhere. Where is that? Hang on, I'll find that. Right, property, plant, equipment, the balance is 1.3 million at the end of the year. All right, so if you look at the, I've done sorry, I'll go down a little bit. All right, so you see, you need to do, they never gave you how much was purchased. So the opening balance of the machinery given was 800,000. You revalued land, other comprehensive income, 100,000. Okay, all this is in PPE actually, not only machinery, less depreciation, less the disposal, and they gave you the closing balance of 1.3. So the difference between, all right, all of this amount and the 1.3 will be your deemed purchases. In this case, in real life, you can see the purchases. Here, the purchases was not given, so you are calculating. So in that case, that's why I put there purchase of property, plant, equipment, and the proceeds from the sale of property, plant, equipment, which is given in the notes on the accounts here. All right, so that will be 50,000. Somewhere I saw it. It always disappears here and there. P&L, I think P&L, right? Sometimes I highlight it, and sometimes I did not highlight it. There's a loss here. There was a statement on how it was sold. Let me see, where is it? Here we are. All right, this one I didn't highlight it. That's a problem. So when you want to do a training, this has to be highlighted. All right, so this amount, all right, net book value sold for cash, PPE for 50,000. So that's the proceed that comes in. So it will come into the proceeds at 50,000. All right, so this is where we put proceeds from the sale of property, plant, equipment, 50,000. So from the effect of the cash flow from the investing activity, all right, so you get 790. From the operating activities, you get 840. Here, there's a net outflow of 790. Now, let's look at the financing. You have issued share capital of 300,000, right? You have proceed from long-term borrowing of 200,000. You also have dividends paid on share capital. So dividends are a financing, remember? So the net cash from the financing is you receive 500,000, but because it is profitable, you paid out 400,000 as dividends back to the shareholders. So as a result of which, your net cash from financing is only 100,000. All right, so if you add up all of these, all right, 840 minus investing 790 plus financing 100, you will get a net increase in cash and cash equivalent of 150,000. All right. Now, then you add, so that's for the year. Now, what is the cash equivalent brought forward? So we go back to the top here and we look at the cash brought forward. Now, remember, we are taking in marketable securities according to what is stated. They regard this as cash and cash equivalent. So we are taking this in 300,000 and the end balance is 450. All right, so let's see how it plays out here. So if you look at this, you will get exactly 150,000, the increase. And then the cash brought forward was 300,000 as showed just now. If we add the two, we should get 450. So this is what is shown in the whole financial statements. So this is where from the same financial statement, you can actually do the cash flow statement. All you do is you need to knock off the two figures every now and then. That's why comparatives are given, and that's the difference where you start. The difference in the working capital, all right, 300 minus 410, whether it's an increase or it's a decrease. So here, the trade payable has increased. So when the trade payable has increased, what has happened really? All right, so that means we got more financing coming in from the trade creditor. And if the trade debtor has increased, what has happened? The trade debtor has increased. That means we are financing the debtor as well. So while the creditor is given, we are also giving more credit. All right, so that's what it is. Now, I did notice some questions. Let me have a look at them. What about gain from the sale of the patent? Now, let me have a look at the item here. All right. Now, the gain from the sale of a patent is already incorporated in the profit and loss account, which has come into this, right? This amount of 600,000. So that means it's already in the 600,000, which we are using. Sorry, it's a 900,000. Sorry, taxation comes out later. Take out the tax. Huh? We start with the profit before tax. Remember, always profit before tax. So the 900 includes the sale of the patent. That means you cannot double take up anymore. It has already been included in the sale of the patent. So the cash inflow already included in the 900,000. So we started with the 900,000. All right. There's nothing to adjust on the cash flow here. So when we look at it, that amount is inside here. The net cash from operating activity includes the sale of the patent. All right. Okay. So next one. Can we record interest paid and interest received under the same activity? Now, usually, under the financial reporting standards, interest paid and interest, unless it cannot be from the same instrument, but from the same activity, you should not. You should show interest income separately on the financial statement. All right, it must be shown separately. What is your finance expenses and what is your finance income? Otherwise, in other words, what's your interest income shown separately on the profit or loss? What is your interest expense must be shown separately on the profit or loss. You cannot knock it off. The reason is this. Investors who read financial statement, or for that matter, anyone who reads financial statement, want to know how much of interest are you paying to third parties vis-a-vis the profit and the operations of the company. So if you knock it off, it gives a distorted figure. So you cannot, right? So it should not be distinct. Now, I thought it should be part of an adjustment. Sorry, this one I'll put this thing. Part of adjustment to be deducted from the profit before operation. Why do you want to deduct it from the profit before operation? You received the cash, all right? You had a patent, your own patent that you built up. You didn't buy the patent, you didn't sell the patent. You have something, and somebody want to buy the patent, right? You give them, okay, 900,000, please. And you say, okay, or maybe you give 1.2 million and finally negotiate to 900. So the cash came in 900,000. Okay, profit and loss, full 900,000 is the sale of the patent. So the amount shown in the P&L is actually the cash received. So that cash received is reflected here. As you can see, the patent that was sold. All right, let me highlight the patent so that I don't have to go up and down looking for it. All right, where is that patent? Sometimes it gets all mixed up somewhere. Sorry, it's inside here. All right. So gain from the sale of the patent. So this is an important thing. Let's highlight this so that we can talk about it and understand it better. So this patent sold for 200,000, profit is 200,000, cash received is 200,000. So when the cash is received, it's debited to bank and credited to where? It credited to gain on the sale of patent. That's a double entry, right? So because it is gain on the sale of patent, is already there. So when we take this figure, 900,000, the cash from there is already inside this, all right? Cash flow from operating activities, that gain is inside here. We never deduct it. If we deduct it, that will distort the cash generated from the operation. So we never deduct it at all. Otherwise, there will be a missing link here. Okay? Right. The cash consideration for the patent will go into the bank account. Debit bank, credit gain in the profit and loss account. All right, credit bank, debit gain in the profit and loss account. So it is in the already in the bank account. So you cannot change it. Okay. Now, finance cost adjusted from net profit before tax supposed to be equal to interest paid. Item next to tax paid. There's no accrued interest at the end of it. Is it correct? Now, let me say the finance cost. Finance costs adjusted from net profit before tax. All right, let's look at that. Finance cost is which one? This one. Let me see. Are you talking about interest expense? Oh, I must go up to here. Sorry. I must always look at the original one here. Do you mean the interest expense? Equal to interest paid next to tax paid. Oh, next to tax paid. Finance cost is this. Interest expense supposed to be equal to the interest paid. Why? Interest expense is 30,000. Right? That's the interest expense next to interest paid. Okay, let me search for the interest paid. Is it given in the question? Finance cost. Because I know this is the finance cost. Profit before tax is this. This is all net profit, dividends, interim dividend, not relevant. I think I missed you on this one. I missed you on this one. Finance cost adjusted from the net profit before tax supposed to be equal to the interest paid next to tax paid, next to tax paid. Where's tax paid? The tax paid is 100,000. Interest paid is 30,000. All right. This is the interest paid and this is the tax paid. Yeah, okay. And you're saying that the finance cost adjusted from the net profit here, next to the tax paid here. This is the tax paid, and that's the interest 30,000, 30,000 and 10,000. Where else is there an interest paid? The interest expense is 30,000. All right, this is 30,000. The same 30,000 we are talking about. Okay, the same 30,000 that we are adjusting here. So I'm not sure which one. All right, I'm not sure which one. There's no interest payable, nothing. There's no interest payable here. So there's actually only interest paid. There's nothing in the here as interest payable, unless it is stated under other payables. There's an interest payable. We will take it out. That I would have put it in the notes on the accounts. There's nothing here, so there's no interest payable. Okay. There's okay. Next one. I will hold this first because I don't seem to be able to patent. It's not. I don't think we need any additional info here. Okay. Correct. Okay. Now that's fine. All right. Okay. Next one. Patent is not on the balance sheet. Correct. Because let's say you develop your own patent. All right. You develop in-house develop intangible assets under MFRS. You cannot take it up in the accounts. In-house develop, you cannot. All right. When you sell it, you gain income. Patent, if you bought the patent from a third party, then you can take up the patent in your accounts. If you develop in-house, you cannot take up patent. So this is an in-house developed patent right. So when somebody wants to buy your patent right or license your patent right, you will sell it to them. So there's no other figure in the balance sheet. It will never be in the balance sheet. Otherwise, it's going to breach. Patent is an intangible asset developed by you in this case. Okay. All right. Now moving on. So this is correct, It's not that the sale is not available. That's all you received. Yeah, okay. So there's no missing information. There's no missing information. The information is available to produce this. In this case, they are equal. Okay, if you say so, I'm not sure exactly what the question is, but if you have managed to find out what it is, we'll leave it as it is. When there is no interest payable, interest expense and interest paid. Yes, if there is no accrued interest, now I can make this more complicated, in which case for a classroom exercise, it'll become a little bit more. Yes, if there is interest accrued, that's a different thing. Cash has not been paid. Then you have to adjust out for interest payable. Where will that be? In the working capital adjustment here. All right, it will appear in the working capital adjustment, which you see here. All right, let's go down here. So this is all the amount here, and the working capital adjustment will then look at it. All right, so here we are. This is the working capital adjustment here. This is all the P&L item. This is before working capital changes. All right, so these are all working capital changes. So if those are working capital changes, okay, then what will happen is that these are the ones that will have interest payable. So the payable will be included inside here and taken off. And there will be a figure in the P&L account which includes the payable. All right, includes the payable in the profit taken out here, if that is the case. Okay, once more, if there was a payable, it would have been included in the profit before tax and it would have deducted interest payable. But because it is payable and no cash is received, we will adjust it in this part here, in this area, under other payables. It would have come off, and then you add it back again. Right? So that's the way it is working. Right? There's no interest payable. There could be inside, but it is not shown. But either way, the payable, whatever is inside, this is the only transaction you will put through, no others. Okay? All right. Yeah. So is that all answered? Anyone you're not sure, please ask. Don't be shy. I want to make sure you understand this in great depth. Okay, thank you so much. Right, for that. Okay, now we have more or less come to the end of this. Now the final session of this. I will give you a copy of this, not to worry. Now, if you don't mind, I'm going to save this file with all the colored inside. So when you get it, you can just have a look at it, why it is colored. So we are going to now go to the final session, and that is the question and answer session. Now, am I going to put up the questions? I will put up the question. Hang on a minute. I will put the questions up. Okay. Now, there's a question that says, can I put interest payable and receivable into financing? Again, what is the interest for before you put into financing? All right. You can put it. There are contentious areas. You can, as long as you can justify it. Right. For instance, interest payable on an overdraft will go into operations usually, because overdraft is for your regular use of the business. Interest from loans, all right, to purchase a fixed asset or term loans will generally go into financing, because you're in substance financing the asset. All right. Now, if you think that if you feel that the machine is producing income from the money that was put, so therefore the interest should actually be part of the operating, that argument also is correct. All right, so that's why if you look at the slide, some of them, there is a gray area, not really gray. You can justify putting a term loan interest into financing or term loan interest into operations, because of the operations that are being generated, they are covering the interest. So that is the argument for it. Yes, you can. All right, but make sure you have some basis of the argument lah. Right? So interest receivable. Now, when you receive interest, for what did you receive the interest for? All right. Normally, an interest receivable is reinvestment. You put money in fixed deposit and you earn interest. If you earn interest from your fixed deposit, you could put it in your operations as well, because that money was actually reserved for your operations, but it's not used currently. So because it's not used currently, you put in its operational income used to pay your normal the normal creditors, debtors, expenses. Because otherwise you keep it there, you earn money. You earn money is to run your business. So that is operation. Okay? But if it was an investment fund and you're keeping it for a long time, probably that will be better put into investment. All right? But again, if you need the money from your longer term investment to run your operation, you can still put it in financing. Operation. It's about how you view the funds that you're using for, how you view. All right. So you can use that. All right. Now let's go on to this. Let's answer the questions now. First one. Now, I don't know how you're going to answer. Okay. How are we supposed to answer the question? Or you say, yeah, I think. All right. Yeah, you can also unmute and talk. All right. All right. First question. What is the significance of the cash flow statement on financial reporting? Very simple answer. Okay. What is the significance? Question one. Right. So you're putting answer 4. All right. Some got 2, some got 4, some got 3, some got 4, 3, 3. Okay. Interesting. Okay. Interesting. Very interesting. Very interesting. Wow. Some got 3 and 4 so. Okay. Because select as the correct answers lah. All right. Okay. Move on. Come on. Move on. There are only 5 questions. Don't worry. I'm not giving you 100 questions. And this is, there's no penalty for you. So the majority of the answers that I can see up to now is 3, 3 and 4. All right. And some have 2, some have 3. So most of it seems to be coming out in 3 and 4. Now the correct answer, the appropriate answer is actually number 3. All right. The whole purpose of the significance of a cash flow transaction on financial reporting is for investors to make the appropriate decision. Now, if you are talking about number 4, to reconcile cash and cash equivalents, that is not really the point of a cash flow statement. Because why do you want to reconcile? The reconciliation is to give investors an opportunity to see. All right. The second answer, to show the profitability of the company, will be not really true. Profitability will always be defaulting to a profit and loss account. Okay. Profitability, collecting cash, is what the cash is all about. So number 1, shareholders can decide. Of course, nobody answered that. That's fine. So the correct answer is 3. Okay. Okay. Now I will also mark the correct answer here so that you can see the correct answer. The most accurate answer it would. Now, let's go on to the next one. Question 2. For a repayment of loans and interests, how are these transactions reflected in the cash flow statements? All right. How are they treated? Are they under operating cash flow? Loan and interest, are they operating? Are they under financing cash flow? Is the interest shown under financing cash flow while the loan repayment is an operating cash flow? Or is the loan capital repayment treated as a financing cash flow? Yang mana satu? Right? Good, good. Carry on, carry on. Interesting. Don't worry, no penalty. Very interesting. Superb, superb, superb. Wonderful. Carry on. Don't stop. There are quite a number. Okay. All right. Now, let's figure out the answer. For a repayment of loan and interest, how is the transaction reflected in the cash flow? The question is loan and interest, right? That's a key word. So, how are these transactions reflected? Oh, somebody's got 2, 3, 2, and 2. That's interesting. First, is it under operating cash flow? Now, the question is loan and interest. All right. You can never put loan, the principal sum, under an operating cash flow. So one is out of the question. All right. Number 2, all right, under financing cash flow. Now, loans and interest, normally in a loan and interest, you won't put both under financing cash flow. The interest will probably, because this is a repayment, all right, you're paying. The interest must come from somewhere. Where did the interest come from? It was earned by the company to pay. This is not interest income. This is an interest expense. So the loan was obtained, is financing. So when you pay the interest, you came out of operation. So it probably could also be out of operations. All right. Okay. Now, the next one, number 3. Interest is shown under financing, while the loan repayment is treated as operating cash flow. Now, interest shown under financing, number 3, is correct. But cash flow under operating, no way. Operating is, it will always come under financing. You got the loan under financing. Repayment is under financing. All right, so loan cannot be. So only one part of number 3 is correct. Number 4, loan repayment is treated as financing, is correct. All right. So how are the transactions? Loan is treated as financing. I didn't put the interest. So the interest will normally come from operating cash flow. But if you pay, say, loan and interest in operating cash flow, is not correct. Loan and interest in financing, not correct. Interest is shown under financing, is correct. But loan repayment as operating is wrong. So loan repayment treatise, this part of the sentence is correct. So the answer is 4. Right? So many of you got it 4. That's good. Some may have got it 2. The financing cash flow, try to understand this. It's confusing, I know. When you get a loan from the bank, it's a financing cash inflow. All right. When you pay the interest, where did the source of the interest come from? It came from your operations, right? So you debit the cost to the operations, loan interest in the operations. So it is actually should not be adjusted out from operation and should not be charged. So you cannot normally put loan repayment interest under a finance cash flow. Better to put it under that. Now, of course, there is no hard and fast rule. All right. The argument is the money came out of the operations to pay the interest. The loan was for the operation. So it came out of operation. So, but the loan cannot be as part of operations. Okay. Very tricky. But that is to massage our brains. Number 3, where there is an increase in the trade creditors. All right. Sorry. How will this affect the cash flow statement? Increase in the trade creditors. So is it an increase in liability and therefore a decrease in the cash flow? All right. Is it no effect on the cash flow at all because the amount is not yet paid? What are we talking about? No cash flow, no this thing. Number 3, the cash flow will decrease while the increase in liabilities is offset by the increase in the purchases. So no effect, right? Number 4, the increase in the liability will result an increase in the cash flow. Which of the following sentences are correct? This one, close your eye also can answer one. Okay, close your eyes and can answer. It's about just common sense. I think most of you have got the right thinking on this one. All right, the right thinking on this. Okay, right. Most of you got it. So it is very simple. The answer is 4. All right, increase in liabilities results in an increase in the cash flow. Very good. Very good. Next one, number 4. All right, number 4. How are cash flows relating to costs that are not recognized as an asset in the statement of financial position be recognized in the cash flow statement? Cash flows that are relating to costs, but the cost is not recognized as an asset in the balance sheet. How do you recognize in the cash flow statement? Is it operating cash flow? Is it investing cash flow? Or is it financing cash flow? Or it is not recognized at all in the cash flow statement. Leave it there in the P&L account. Well, a lot of answers coming out. This statement is in the slide, actually. Okay, I just put it there so easy for you to also refer back. The statement is in the slide. Okay, right. When the key point here is that when there is a cash flow that is not recognized as an asset, that means you paid for an expense, it is operating cash flow. If it's recognized as an asset, then it's probably investing or financing. So the key point is here. It must be recognized as an asset to be either investing or financing. Otherwise, if it is not recognized, then it is automatically must default to operating cash flow. That means it is an expense. It's a cash flow relating to an expense. So it goes into operating cash flow. All right, simple. So the answer is correct. Yeah, most of you, in fact, all of you, other than a few, may be a little bit confused, not to worry. And the last question for the day, which is a company has fixed deposit of 3-month duration. This one, you close your eyes, you know already. And these are pledged to the bank for short-term financing. How should these fixed deposit be shown in the cash flow statement? 3 months duration, pledged to the bank for short-term financing. All right. Now, this is a gifted question. Very interesting. None of the above also got. Interesting. Excuse me. Let me clear my throat before I answer this question. Okay, I will answer them. I think in this one, a lot of you got it not so correct. You see, the key word here is this. These are 3-month duration, yes, but they are pledged to the bank, all right, for short-term financing. Short-term is not 3 months financing. Short-term means 1 year or 2 years, all right? Long-term loan is normally a few years, all right? This short-term. So when they are pledged to a bank, they can never be cash and cash equivalent. A cash and cash equivalent means that you must be able to take it out anytime. Although the company duration is 3 months duration, that means they are pledged to the bank to this thing. Now, unless we say that pledge to the bank and the short-term financing is only 3 months. Now, let's understand this. In real practice, 3 months financing cannot be doing very much. If you say trade financing is different, all right, trade bills financing, that means you take your creditor and pay and then pay back. That's different. That they will never normally try to put your fixed deposit in. So what they will do is they will just ask you to give a guarantee and take it like that. All right. Now, short-term financing will normally be at least a year to 2 years. That's short-term. Okay. Now, if the 3 months duration fixed deposit, what the bank will want you to do is every 3 months auto renew. Why you want to put 3 months? Because if there is a rising interest rate, once you lock your fixed deposit for 1 year, you cannot touch it. But when a 3 months fixed deposit, if there is a rising interest rate, the next renewal will get a better interest rate. The next 3 months will get a better. But if you are on a downtrend of interest, you will then not lock it up. You will lock it up for 1 year. But if it's an increased interest rate in Malaysia, like now, there is an interest rate increase slowly, you will lock it only for 3 months. That's what I do in some of the clients. We advise them 3 months or 6 months renewable. Don't lock it for a number of years. So the confusion here was deliberately put 3 months duration, short-term financing. It is actually never under part of the cash. Even though if it is, it's pledged to a bank. To take it out of a pledge means you got to break the pledge. Breaking the pledge is not instant. It may take a week, 2 weeks, all right, for them to discharge that. So that is not a cash and cash equivalent. Rather, it is an investment, all right? This is actually an investment under investing activity. So you pledge it, actually you put the money in your investment and earning interest for a period of time at different rates of interest. Okay? Interesting. So this is the answer to the question, really, is number 2. Always go back to the logic. Now, I'm applying the logic because I'm using the actual experience in the practice as how it is done. All right, because when we are reviewing so many of the cash flow statement, we ask question, why do you put? They say, I don't know, I just simply put there. Then we go down and ask the question, what did you use the funds for? Where are you generating? Then we discuss with the client, say, shouldn't be this. Then they say, okay, yeah, I believe so. We didn't know. So this is the way we look at it. All right. So the right or a wrong answer, first understand the background to it.